Welcome to the Deep Dive. We are jumping straight into the numbers that moved the market yesterday, and we're focused on First Horizon, that's ticker FHN, right after their Q4 2025 earnings call.
Yeah, this was a really critical print for them. I mean, not just for the Q4 numbers themselves, but for, setting the whole narrative for 2026. The theme here was crystal clear.
And what was that?
It was all about disciplined execution on the operations side, and then pairing that with a really aggressive focus on shareholder yield.
And the market absolutely loved it. It was a loud and clear affirmation. The stock finished the day up 1.62%, but the key thing for me was the volume.
Oh, absolutely.
It was nearly double the 20-day average. And, when you see a positive move on that kind of heavy volume, it just screams conviction.
Yeah.
Investors weren't just passively watching, they were actively buying into the story.
And what they were buying into were the headline numbers. Yeah. It was a clean beat right across the board. GAAP earnings per share came in at $2.53, which pretty handily tops the $1.46 analyst consensus.
So a 7-cent beat, that's a nice bit of breathing room.
A very healthy margin. And adjusted EPS, which is really what we look at, came in at 52 cents.
And the top line held up, too.
It did. Revenue was $892 million, beating the consensus of about $864 million by a good $28 million.
So if you zoom out from just the quarter, how did the full year 2025 shake out for them?
The full picture is solid. For 2025, they delivered $956 million in net income available to common shareholders. And that's the number that really matters for us equity holders. That works out to about $1.87 in EPS for the year.
Which just confirms that they navigated a pretty choppy year and came out with sustained, solid profitability.
Exactly.
And that profitability ties directly back to what you said about shareholder yield. Let's talk about the capital return.
Management was very aggressive in 2025. They deployed almost $900 million in stock buybacks, $894 million to be exact.
Plus the dividend.
Plus over $300 million paid out in dividends.
Yeah.
So substantial deployment. But here's the kicker for the future.
The remaining authorization.
Of the $1.2 billion buyback plan the board approved, they still have roughly $1 billion left.
$1 billion. That's a huge amount of dry powder. And it really frames the entire story for 2026, doesn't it? It's all about how and when they put that to work.
It is. But that authorization is only as good as the balance sheet that backs it up. So we should probably dig into the discipline that gives them this confidence, starting with net interest margin. NIM.
Right. This was probably the most technical part of the call, but also one of the most important.
It was. So the Q4 NIM was 3.51%. Now, on the surface, that looks like a 4 basis point compression from the last quarter.
Which isn't great.
But management was very quick to clarify that if you adjust for some, one-time noise, specifically the impact from the Main Street lending program accretion, NIM actually expanded by 2 basis points.
Okay, let's pause there for a second. For listeners who might not track every single nuance, what exactly is that Main Street lending accretion and why are we backing it out?
It's essentially some leftover income from that old pandemic era lending program. Yeah. It's not core. It's not repeatable banking revenue. So by pulling it out, management is basically saying, look, our underlying organic earning power is actually getting stronger.
So that swing from a 4 basis point drop to a 2 basis point gain is a huge signal about their internal execution.
A massive signal. And that execution was really driven by one thing above all else.
Deposit discipline.
Deposit discipline, exactly. The biggest benefit came from just a relentless control over their deposit costs. The average cost on interest-bearing deposits fell 25 basis points quarter over quarter. It's down to a very tight 2.53%.
And how does that stack up against their peers? I mean, what does that mean in competitive terms?
It means they're outperforming. They have successfully kept their cumulative deposit beta, that's how much of the deposit costs move relative to the Fed's rate changes, at just 64%. And in the regional bank space right now, 64% is exceptionally good. I mean, you have a lot of peers running closer to 70%, even 75%. That difference, that gap, it drops straight to FHN's bottom line. It's a real structural advantage.
Okay, so let's flip to the other side of the balance sheet. Loans, we saw some pretty decent growth in Q4.
We did. Total period end loans were up by $1.1 billion. That's about 2% sequential growth.
And what was driving that? Where did the growth come from?
Well, the main engine was, kind of surprisingly, in the countercyclical parts of their business. Loans to mortgage companies shot up by $776 million in the quarter.
Okay, so they're seeing the refi market pick up.
A big pickup. Management noted that refinance now accounts for about a third of that activity, and that's up from just 25% before. So that's a real shift.
That makes sense with rates coming down, but the big question for investors is always about core commercial demand. How did the C&I portfolio look?
That looked encouraging too. C&I balances increased by $727 million. Last quarter, the big question was whether all this talk about business optimism was actually turning into companies drawing down their lines of credit.
Right, talk is cheap.
Exactly. Seeing this kind of activity, it confirms that optimism in their regional footprint is translating into real loan activity. And that's a powerful signal.
And just before we move on to guidance, circling back to deposits for a second, management made a pretty interesting point about what's driving their pricing strategy. It wasn't just competition, was it?
No, it wasn't. They were very clear that they see the macro picture, system-wide liquidity, the pace of the Fed's balance sheet runoff as a bigger factor on deposit pricing right now than just direct local competition.
So they're saying the tide is still lifting all boats, which lets them be more disciplined.
That's a good way to put it. It allows them to maintain that pricing power effectively.
Okay, so that's the engine that drove Q4. Let's look through the windshield now at the 2026 guidance. What did they commit to on the revenue side?
They gave a range, 3% to 7% year-over-year growth in total revenue.
That's a pretty wide range. I guess that reflects the uncertainty out there. What's the baseline for that, and what gets them to the high end, to that 7%?
The base case, sort of the middle of that range, is anchored on the current forward rate curve. Basically what the market thinks rates are going to do. The upside comes from two things. First, if they can beat their mid-single-digit loan growth targets. And second...
Those counter-cyclical businesses again?
Exactly. An acceleration in mortgage refi, fixed income capital markets. If the market gives them some favorable volatility, they are set up to capitalize on it and capture that fee income.
And on the expense side, they said flattish, which always sounds great. But are we worried they're underinvesting? If they're holding costs flat, are they maybe sacrificing tech upgrades that they'll need down the road?
That's always a fair question.
Right.
But management tackled that head on. They said their core inflation for expenses is running about 2.5% to 3%. But they're offsetting that not by cutting into the bone, but by the completion of several big multi-year tech investments.
So they're moving from a spending phase to a benefit phase.
Exactly. They're done with the high CapEx part, and now they're going to start realizing the efficiencies from those projects.
And the only way expenses really go up is if they're making more money.
Precisely. They called it a high-class problem. They view higher expenses that come from commission-based revenue, from their fee businesses outperforming, as a great thing. It's not cost creep, it's just sharing in the success.
This all feeds directly into that big number they keep talking about, the $100 million plus incremental PPNR opportunity, pre-provision net revenue. How are they going to get there?
Right, and they reiterated that this is going to build significantly through 2026 and 2027. And look, this isn't about some huge M&A deal or a massive market expansion. It's really an internal story. It's about closing a competitive gap.
A competitive gap? How so?
They know they are underpenetrated in some of the stickier, higher margin services compared to bigger banks. So they're really pushing to sell more treasury management and wealth management products to their existing clients.
So it's a cross-selling story.
It's a classic cross-selling story. Think of it this way. That $100 million PPNR is the money they can make if they just get, say, 10% more of their existing commercial clients to use their treasury services. They already have the customer, they just need to deepen the relationship.
And that focus on sustainable profit brings us to their bottom line target, the ROTCE.
Right, return on tangible common equity. They hit 15% adjusted in Q4.
Right.
And management was very firm in saying that 15% level is now sustainable going forward. There will be some quarterly wiggles, of course, but that 15% is the new floor they plan to operate from.
Okay, for investors to really buy into this, though, they need confidence in two things: credit and capital. Let's start with credit.
The credit performance was stellar, and honestly, it's what enables everything else. Net charge-offs were just $30 million, or 19 basis points. Perfectly in line with what everyone was expecting.
But the real headline grabber, the thing that I think moved the market, was the provision number.
Absolutely. They recorded zero provision for credit losses in Q4. And you have to understand, this isn't just a quarterly beat. This is a signal.
The end of the cycle.
It signals a definitive end to the credit reserve building phase. For regional banks, that's been a massive psychological hurdle. So management is saying, we're done building reserves. And they see NCOs staying low in that 15 to 25 basis point range for all of 2026.
And the underlying portfolio health is improving too.
It is. Total criticized and classified assets actually fell by 11% in the quarter. So things are getting cleaner.
Okay, what about the big, scary monster for every regional bank? Commercial real estate. What was the outlook there?
They actually see an inflection point coming this year, a shift back to growth. They said the pipeline is getting stronger, construction starts are picking up,
Yeah.
especially with rates expected to fall.
Any hard data on that?
Yes, actually. They pointed out that total CRE commitments increased this quarter for the first time in about 2 years. That's a pretty strong forward-looking indicator that the gears are starting to turn.
They also spent some time on their non-deposit financial institution, or NDFI, exposure. There's been a lot of noise about that sector.
Right, and most of their exposure, about 2/3 of it, is in mortgage warehouse lending. But they really emphasize their safety measures. They do things differently than some peers.
Like what?
Well, they take physical possession of the actual notes, and they choose the closing attorney. Think about it. Instead of just trusting the borrower with the collateral, they literally lock the collateral up in their own vault. That physical control fundamentally de-risks that business for them.
That active risk management brings us right back to capital. Credit is stable. Profitability is at 15% OTCE. So the market is just staring at that remaining $1 billion buyback.
They are laser focused on it. Their near-term capital target, their CCT1 ratio, is 10.75%. But the goal, the intermediate-term goal, is to get that down to between 10% and 10.5%.
And they were very clear on M&A.
Oh yeah, emphatic. M&A is not a priority. The focus is organic growth and disciplined deployment of that buyback.
So what's the trigger to get more aggressive and move toward that lower 10% target?
They said they want to see the favorable economic data continue to play out, so they're being measured. But, the pressure to deploy that excess capital, it is mounting very, very quickly.
All right. This is the perfect time to transition. Before we wrap up this deep dive, let's connect all these dots to some potential outcomes.
And the standard disclaimer applies here. We are just summarizing the investment implications from what management has publicly stated. This is information and context only. It is absolutely not financial advice.
With that necessary context in place, let's hear it. What's an outrageous but plausible trade idea based on everything we've just discussed?
Okay, the thesis is pretty straightforward. Go long FHN with a bet on an accelerated return to that intermediate-term CCT1 target of 10.0% by the end of 2026.
Accelerated. But you just said management sounded conservative on the timing.
I did, but the economic reality is that the pressure to deploy that capital is reaching a boiling point. Look at the facts. They're generating sustainable RDCC over 15%, the credit reserve build is officially over, and they are sitting on $1 billion buyback authorization.
Which is a huge chunk of their market cap.
A very substantial amount. If they get aggressive with that buyback, which they are fully authorized to do, they could bring that CCT1 ratio down much faster than their conservative public guidance suggests.
So this is basically an execution trade. You're betting that their own strong performance forces their hand to move faster than they're letting on.
That's it, exactly. And if they hit that 10.0% CCT1 target sooner than the street expects, it would force a material re-rating of the stock compared to its peers. It would close that valuation gap and drive some real shareholder value. It's an entire argument built on disciplined capital return.
That's a fantastic summary of the implications. So to quickly recap our deep dive on FHN, a strong EPS and revenue beat, all driven by that superior deposit pricing discipline. Management sounds confident in that 3% to 7% revenue growth. And maybe most importantly, that zero provision says the credit worries are in the rearview mirror.
And all of that just anchors this incredibly compelling capital return story built around that remaining $1 billion.
All right, one last thing. Let's leave our listeners with a final provocative thought.
Here it is. Watch two things very closely in Q1. First, the pace of the buybacks. How quickly are they actually eating into that $1 billion? That's going to tell you their real level of urgency.
And the second thing.
Watch the C&I utilization rates. Management says they hear optimism from their customers. The question is, will that optimism translate into those customers actually drawing down their lines of credit? Because if they do, that could drive growth well beyond the middle of that target range.
That's where the real unexpected upside could come from in 2026. Thank you for joining us on this deep dive. Remember, we've provided information in context only to help you better understand the numbers. We hope this briefing informs your next decision.